Well, good evening, everybody. Ron Wheeler here, and it's my pleasure to bring you tonight's special presentation, Capital Preservation, the Key to Long-Term Success. Your first job as an investor is easy. A lot of people think it's all about making money, and in a part it is, don't get me wrong. But to make money, you have to learn to not lose it. And capital preservation really is what's going to hold you through those times when the market's volatile, when it's going against you, and allow you to stay in the game for the longest time, because that's really what it's all about. The longer you can maintain, the longer you can hold your positions, the longer you can stay in the market, the best chance you have to make success and make money. So tonight I want to talk a little bit about portfolio insurance. This is something that you can do, and it's an easy trade. It's something that every investor that has a portfolio stock should know. And this is also something that we teach in our retirement portfolio transformation. It's actually module 5, and we'll talk a little bit more about that a little bit later on, and how you can access the educational materials for this to learn even more than what I'm going to cover with you guys tonight. Now, the idea of this is to use one simple options trade. And don't start getting scared when you think options. I'm not going to go into some complex option strategy where we're doing weird spreads and it's something that you're going to have to figure out how to learn. This is a very, very simple way of protecting your entire portfolio with just one trade. And the quote that we always like to use for this is a Mark Twain quote. Don't just sit there and worry. Be proactive. Do something, anything about what's worrying you so you can gain information, focus and control over the situation. And as he said, I've suffered a great many catastrophes in my life. Most of them never happened. Now, as part of the retirement portfolio transformation, we break things down into 3 sections. First, you have your capital appreciation. And this is important. This is the stocks that you're going to buy, whether they're dividend payers, whether they're growth stocks. These are the stocks that you're going to own to take advantage of the rise in price. Now, income, talk about that in another module. So we'll leave that one kind of on the side for right now. But capital preservation is what we need to do during downturns to protect that, because there's always going to be a lag, if you will, between when you might get stopped out of an individual stock and when that market turns. So we have to have some protection in the middle of that. That way, if you do get stopped out of your positions, you're going to have something going in the background that is going to cover that and actually give you some damage control, if you will, for those positions. Now to start, what are some of the signs to become defensive? Well, first off, we can look at the MTI, right? The MTI above 1.5, and then the MTI falling when it's going from 1.5 to 1.4 to 1.3. Maybe you get a red light in the price column of the color guard. Or what I like to use personally is the DEW. If the DEW is turning down, the DEW timing system, if that's turning down, this could be your sign to go ahead and add some portfolio insurance. Now, there's also on here earnings announcement, but I would take that as more of an individual stock protection. I wouldn't use portfolio protection for just an earnings announcement. So again, let's kind of circle back to what we want to do. We want to eliminate risk with one simple trade. And it all comes down, and this is the cool part about this, it's very, very simple. You simply buy a put. Now, you may be familiar with this. Hey, I own 1,000 shares of Apple and they have earnings, I'm going to buy a put. That's great, you should do that. But how do we protect the entire portfolio with that same put? Well, it's very simple. You buy puts on an index option, because all of those stocks that you're owning, all of those stocks are tested and weighted against a major index like the SPY, the spiders, or the index SPX for larger valued portfolios. We can do this just simply buying a put on either the SPY or the SPX. Now in this particular session, I'm going to talk about the SPY, looking at account size of roughly $250,000. Let's say you have $250,000 in stocks in your portfolio. Now I realize that all of your stocks aren't going to be beta weighted to the SPY 1-to-1. I get that. But, typically a portfolio is pretty highly weighted to the SPY anyway. So we can use the SPY on a one-to-one basis really to protect our portfolio overall. Now, before I get started, I would be remiss if I didn't discuss our colleague Jim Penna, who we lost last week. Jim was a good friend of mine. We worked together in the retirement solutions. Jim covered the capital appreciation side of the retirement services, buying good stocks, dividend-based portfolios. He then kind of transitioned a little bit into the beginning income side with things like covered calls. I know he started doing the wheel strategies recently, and also doing portfolio hedging as well. And Jim and I worked together on the option side of this, mainly to make sure that all of our option stuff was kind of in sync with each other. And what you're going to see in this presentation tonight is really Jim's work of the retirement portfolio transformation, and how he kind of came up with his system of doing the capital preservation by using the puts, and really you're going to see his work. And it's a tribute to him, really. And as we go forward, using his materials, using his slides, using his great work, it'll kind of make a lasting tribute to him, and we all appreciate that. So, we're going to miss Jim here tremendously. Like I said, Jim's been a friend of mine for, since 2015 when I started here at VectorVest. We traveled together, we worked together really well, and I'll definitely miss him. And I know based on the tributes and things that were pouring in from those of you around VectorVest and VV Nation, you guys will as well. So we pay tribute to him tonight for this presentation. So let's put together a case scenario here and kind of show you how this works. So first off, let's go to one of my favorite ways to do this, is that's with the DEW timing signal. And as you can see, in late February, the DEW did turn down on the market timing graph. Now, since we're discussing this on an SPY or an SPX basis, again, thinking that our portfolio is beta weighted pretty highly to the SPX, let's take a look at the actual graph of the SPY at that same time. So you can see on February 21st, that's really when the S&P hit that high before the big sell-off. And we also got the DEW down that very same day. Now, what I want to do is I want to kind of simulate something here. Let's say, and I'm going to take this graph of the SPY and let's look at some more data on this thing. Let's pretend that you opened up a portfolio on the S&P somewhere in late 2004. In fact, if you want to, we can kind of even line that up and say, the confirmed call came in, there was a confirmed call, I should say, right around $560 back in August of 2024. Now, I realize there was other confirmed calls and things like that too, but hey, you got to pick a spot at some point to launch a case study here. So let's say you bought $250,000 worth of stocks that were relatively weighted one-to-one with the SPX. And again, that's pretty much most stocks out there anyway. So, and I'm talking about stocks that are like blue chip portfolio stocks, premier growth stocks, name brand stocks that everybody would know. Here's what I want to show you. What I did is I loaded that up into Options Pro. And don't start getting crazy about, Options Pro, it's going to be confusing. I'm going to not make this confusing. I'm going to try to make this easy. And really, the only reason I want to show you this is because it gives a good monetary value of this. So you can see over on the right-hand side that the debit cost of the trade that I simulated. So basically, I'm simulating you would be buying 450 shares of the SPY. I'm buying them at $560. It's basically you're buying a stock here. Now, why am I showing you this? Because again, we're simulating that our portfolio is relatively beta weighted to the SPX. So if you would have bought those at $560, as of right now, June 20th, 10:37 a.m., your portfolio would be up about $16,000. That's pretty good. I think it's pretty good. $16,000 in, not too long. I mean, that's good. That's what is $16,000. That's, not quite 10%, but it's, it's in the high single digits. That's a pretty good return. However, you got to remember what the S&P did during the last 6 months. Let's go back to the SPY graph. Here it is. The SPY started trading, and let me go to the SPY graph, pardon me, here we go. The SPY at that time, and that was right here, had dipped to as low as $480. Now, in hindsight, I can look back at this and just kind of shrug my shoulders and say, oh, well, the market recovered from there. But what if it didn't? What if it didn't recover? Or could we have actually kept our positions and even profited from this? Well, we know that we got the DEW down in February. Okay, so what do? How do we protect this? Because remember, it went down as low as 480. If you would have held this thing all the way to 480, your portfolio would have declined by $36,000. That's where this is right here. You can kind of see it over to the right around $36,000. That's a pretty big hit. That's over 10%. So what could we do to protect this? And again, the answer is we're going to buy some puts. Now, what puts should we buy? Where should we buy them? How do we manage the trade? Now, there's only so much that I can, do in a strategy of the week in 15, 20 minutes. So remember, this is a setup for the entire process that we're going to talk about next week. So rule number one for the protected put: when setting up the trade, we're going to use a shorter window for the sweet spot. 30 days should give you the time you need to evaluate any news or market uncertainty. Now the next question is, how many puts do you actually buy? So we have a formula for this. We take the number of contracts, that's how many puts you're going to buy, and the calculation is you take the value of your portfolio divided by the put strike price times 100. And the reason why you use that times 100 is because one put controls 100 shares. So for our particular example, we have a $250,000 portfolio. We're going to take 600. That's the strike price. That's where the SPY was currently at when we're doing this, times 100. So that 250,000 divided by the 60,000 equals 4.16. So we could either do 4 or 5 put contracts. You can go either way. You can go a little bit over, you can go a little bit under. I generally choose to go a little bit over because extra protection, a little extra protection is not too bad. So let's talk about this. We go out there and we buy 5 put contracts back here, and we're going to use the March 21st expiration. Why the March 21st? It takes out about a month and a half. Now, you could use the monthly contracts. Also, another great thing about trading the SPY is that you could trade weekly contracts as well. And the weekly contracts still have enough liquidity for you to do this. So you can really time this down to 30 days very, very well. Now, as the market takes a tumble, you're going to see the value of your puts start to increase dramatically. So the first fall, you have all the way to February 27th. At that point, the SPY has fallen down to about 585. Now, 585 isn't too bad. Let's take a look back at your value. So at 585, it's sitting at about right here where I'm going to put this arrow. At 585, your portfolio is valued at $260,000. And again, if you look to the right, following that the red crosshair, it's $10,149. That means you are profitable $10,000. Now the cool thing is that the market's kind of almost at 600 right now, so we can kind of use the current price of up 15.7. So your value of your portfolio has dropped from 15, let's just call it 16, $16,000 to 10. However, remember, your puts that you bought have now become worth $4,600. You've taken that down to a very, very small loss. Now, as the market continues to decline, you're going to see the value of those puts start to increase. And if we go down to the absolute low, this is when the market reached 550. Those puts are worth $19,522 of profit. Now, let's go back to the graph. At 550, your portfolio has lost all of the gains and is actually sitting at a $4,200 loss. That's this point right here. okay? But those puts have actually made it profitable for you. Now, that's not how it's going to happen all the time. It just happens to have happened in this particular case. You now have a position to where your insurance has completely taken the loss of the SPY and your portfolio and has basically put you back up to where you were. Your stocks lost money, but your puts took care of that situation. Now, the question becomes, well, Ron, are you really going to get out at the low at 550? Probably not, okay, unless you're like the best market timer that ever came about, right? Those options are going to expire in a couple of weeks. So let's say, and then really the market bounced back up here too. So let's say we're getting closer to expiration and, the market popped up right about here, right where I got my arrow pointed. And let's say you get out basically right at expiration. Even at expiration, you're still up $13,000 in that trade. That's the beauty of it, okay? And at expiration, you're sitting there and the value of the index is back to 575. So the index is at 575. Your portfolio, that's relatively beta weighted to the SPX, right? We'll take a look at the profits on that. And your options profits are now $13,000. So at 575, where are we at? At 575, our portfolio is up about $6,700. That's great. And we still have about $3,000 or $13,000 in options profits that we can take. So, we're basically right where we left off with the S&P at $600. We're still up $16,000. Now, let's go back and look at the graph of the SPY again. Okay? Because again, it wasn't all roses here. The market rallied. It came back down. It looks like it was going to hold down the previous low, but it didn't. The market had a nice big gap opening and we took out the low. Well, guess what? Your insurance had expired by that point. And you could have put insurance on again if you wanted to, but let's be honest. You're looking at the market, it's holding support, it comes back down, even after your insurance expired. Yes, it's down, but it's, it's got support right there. Let's see if it holds it. This is what the investor thinks. This is what I would think. All right, starting to rally and then boom, right there. Guess what? We start going lower again. We took out the previous low. Let's go ahead and add more portfolio insurance. At this point, the S&P is now at 540. Okay? You've already taken $13,000 in profits on your original portfolio insurance. So as of that date, you're right here at 540. Let's take a look at this. So, on that date, we go out 30 days from that date and we buy more portfolio insurance. We bought 5 May 2nd, and again, I'm using the weekly because I'm keeping the expiration about 30 days. We bought some 545 puts. Why 545? That's pretty much where the market opened, and they opened that day around 1350. Now, as the market comes back down, we retrace to a low of 490. At 490, your profits on that trade are 14,876 at the very low of the market. Okay, at the very, very low. So, let's go back to our graph. At 490, that's all the way down here. Your portfolio is down $31,000. Now, that's a big loss. It's over 10%. But remember, we had $13,000 in profits before, and at that absolute low, we had another $16,000 that we could have realized. Okay? That's at the lowest point. You were down $30,000, but your insurance was actually up in total $29,000. You could have called it quits right there, and you would have basically been able to walk away with no loss. Okay, that's the beauty of this. Very little loss. Now, we all know what happened. The market started to rally from there. Realistically, would you have done that? I don't know, probably not. But as the market continues to move, you start going higher and higher and higher. And let's go back to a market timing graph. Let's take a look at the DEW system again. The DEW turns back up on April 23rd. Well, on April 23rd, let's say this is where you finally said, you know what? Let's go ahead and kind of cancel our insurance. Do we need it anymore? I mean, you can look at that and say, okay, well, there's a trend line. There's the DEW. It's popping up over here. Maybe you even did it a little bit later. Maybe you canceled your portfolio insurance, 425, 426, 428, when the S&P was back up to around 550. Okay, great. That's April 28th. On April 28th, that trade was still only down a little bit. Okay, you would have lost maybe $5,000 on that trade. That's not a bad loss. It's not a bad loss because your portfolio underneath it all is turning around. Now, if you'd have simply just used, okay, the DEW turned back up on April 23rd, you could have gotten out of your hedge for a loss of about $1,400. That's not bad. So you wouldn't have made that $13,000, okay? You actually would have lost about $1,400. That's okay. So let's take a look on April 23rd. Where are we? Where are we in the trade? All right, we're back to 540. 540 is about right here. We're down on our portfolio about $8,000, but we're really not, remember, because we've already made, that $13,000 on our original hedge. So we're up about 5% on our portfolio at that point, okay? 4%, 5%, and now the S&P is back off to the races. You're up 15,363, and you're still sitting on a very, very nice profit from your hedges. And all it took was buying puts. That's it. It wasn't some complex option strategy. It was simply going out there, knowing the value of your portfolio, and buying the appropriate puts. And again, if you want to make this turnkey, it's very turnkey. The do down, you take action. The do up, you take the action off the table. That's all you need to do. Keep it simple. Now, what you're seeing in this particular strategy, this is something that is taught in the Retirement Portfolio Transformation course. Now, here's the good news. The Retirement Portfolio Transformation is being added to all of your accounts free of charge. You're going to get this course. You're going to be able to access the recordings in the university site. So you'll be able to go through there. You're going to be able to access the course, see everything. In the full Module 5, which, by the way, I'll be doing a Module 5 mastery session on Wednesday. Let me get the date for that because I don't have the date on top of my head. June 25th, I'll be doing a mastery session. Now, in that mastery session, we'll also be kind of covering the concepts of doing collar trades and covered calls on individual stocks. This is something that every investor should know. Make it simple, make it easy. Index options really do protect your entire portfolio. And again, you can make this as turnkey as you want. So to access the materials for the Retirement Portfolio Transformation, all you need to do, you're going to go to university.vectorvest.com. You're going to click on My Courses, and you should see it. Again, this is going to be all activated into everybody's account on Friday. So give it a little bit of time and you should be able to access that course. In fact, this is what university.vectorvest.com looks like. Now, I have access to the coaching groups. You may not have that. If you scroll down under My Courses, now you probably won't have all 31 of them listed. You're going to scroll down until you see Retirement Portfolio Transformation. It'll say Start Course. If you click on right there, it'll actually go ahead and load up all of the modules. And again, I would encourage you to view all the modules. These at your leisure. Retirement Foundation Builder. Jim's going to teach you in these early modules how to build a solid growth capital appreciation portfolio. And then as we get into module 4, we'll talk about doing covered calls. In Module 5, what I kind of previewed a little bit tonight is all of the trades that we'll talk about, the collar trades, the covered call as a defensive mechanism. All of those are right there. And again, you can join me on Wednesday for that mastery session where we'll discuss it live. That's going to be in the community room. If you go to VectorVest, the main page of VectorVest, if you click on the training tab, you can click on the VectorVest Investor Community right here. And at noon on Wednesday, we will be doing a live mastery session to answer any questions. So take the next couple of days if it's interesting to you. View that Module 5. Come to the mastery class with your questions, and we'll be glad to help you along the way. So thanks once again for joining us this evening. I appreciate it. Hope you learned something valuable about protecting your portfolio as we kind of climb this wall of worry, as my coaching clients like to think of it. And I do too. I mean, you're always thinking about that next downturn. So as you're thinking about that next downturn and possibly that next due down, be ready to implement what we talked about tonight. Thanks again, everyone, and have a great weekend.